This podcast is for financial professional use only and is not intended for use with the public. Material is for informational purposes only and is not intended to provide tax, legal, or investment advice. The opinions expressed in this podcast are those of the participants and do not necessarily reflect the views of Ash Brokerage. Welcome to Accumulation to Activation, the podcast that breathes life into your retirement planning strategies. If you're an advisor aiming to elevate your practice, deepen client relationships, and stay ahead of retirement income trends, we'll help you capture the opportunities on your doorstep and increase your impact. Each episode, we'll unpack the forces reshaping our industry, from the $44 trillion generational wealth transfer and the evolution of income planning to behavioral shifts, legislative updates, and breakthrough solutions that redefine financial security. Here are your hosts, Mike McLaughlin and Tim Ash.
Hello, everyone, and welcome back to Accumulation to Activation, where we talk about all things retirement income planning and taking the risk off of retirement and making sure that we improve the outcomes for so many Americans. I am joined, as always, with Tim Ash. So, how are you doing today, Tim?
Couldn't be better, Mike. Enjoy our time together on this podcast.
I know that you are going to be fired up about this episode. We are continuing our series of breaking down the Fisher investments, 9 questions that every annuity investor should ask. We want to talk about some of the omissions, some of the misstatements, some of the facts, but also just because Fisher investments are great marketers, many times you as listeners will run across or have questions come up from clients about this biased view. And so we want to provide you with some ample opportunity and ammunition to answer any type of questions. So if you go back and look at the or listen to the previous episode, we talked about the first 2 questions about why and what types of annuities there are and really some of the omissions around that. Today, we want to break down some of the expense questions that Fisher Investments talk about. And question number 3 is, what type of expenses does an annuity have and what is the overall cost? The example that they use has a 3.70% fee drag. Now, that is not unusual in the variable annuity world. And so, Tim, talk a little bit about our annuity performance review, what it's been doing for so many people to help identify this and also increase income or increase capital.
Well, thank you. I'm glad to jump into that topic around expenses. And I don't believe that the Fisher Investment Annuity Insight Report is saying anything incorrect. But I do think there needs to be a little bit more of the layers of the onion, as they say, peeled away. So, variable annuities, those that have income benefits or withdrawal benefits in them, do have expenses that we see that are well north of 3%. We've even some in the 4% range. And so, what we have built is a tool called the APR, Annuity Performance Review, and it assists advisors and clients in evaluating their in force annuity that they have. And most of what we see are variable annuities because that's the largest product category that has been sold for decades inside the annuity world. So the Annuity Performance Review does an objective evaluation of fees, expenses, and if a client has turned on income, what that income's doing, and is there a better solution for them out there. And it also incorporates, because many variable annuities that are in force are built on a single life and not a joint income. So most folks in retirement, a high percentage, are married, and they don't want just a single income. They want both lives to be protected and covered for that income. And so we help evaluate that. And this is where advisors have, I'd like to say, have a bias. They say, hey, I have my client bought a variable annuity. They've turned on income. It's a single life. there's nothing I can do. I can't change that or improve upon the performance. They turned on income 5 years ago. They turned on income 7 years ago. I will tell you this, in over 90%, you have the exact stats, Mike, over 90% of the variable annuities that we have evaluated, we have improved by close to, it's approaching 40% improvement in income. And in many of them, we are able to turn it from a single life to a joint life. So not only are you getting a pay raise, or potentially you may say, I don't want a pay raise. I don't need it. I'm fine with the income the annuity is providing. So it's a great way for you to free up assets that you can manage differently in your equity portfolios, in other things. So what I look at, I do, like I said, I agree with the Fisher report. You have to look at the expenses, but that's just the tip of the iceberg that's above the surface of the water. It's the things beneath it that matter. So that's my take. And the tool that we have, APR, it's so simple for you to obtain. Contact your retirement income consultant. Send us an email. Send us whatever. We'll run the report for you. All we need is a picture of the statement, and we do the rest.
Yeah. And there's a great line that I learned early in my sales career: cost is only an issue in the absence of value. When you think about cost of income riders on fixed indexed annuities between 90 basis points and 110, that's a small price to pay in order to take that longevity risk off the table and not have to worry that I will run out of income at this point in time. That is so important. And when I think about some of the risks that we're going to be faced about over the next 25 years, that we just haven't saved enough money, we're going to lose 24% of our Social Security here, or get pushed back. We're losing defined benefit plans left and right, and we're living longer than ever. That's just a huge risk. That 1% is a small price to pay, and it's equivalent to that of professional money management, basically. Um, I think it's super important that we take a look at how do we how do we leverage that cost into something that's valuable? And we touched on our last one, but it's important. Where does it fit into the plan? And when you think about freed up capital, one is that can certainly go back into our assets under management. But you always talk about there are some significant health risks, healthcare, long term care. We can take some of those off the table with freeing that up.
Yeah, I agree. I'm very passionate about the healthcare conversation in retirement, because the amount of people that are 65, 75, and 85 and older is just going to continue to climb. And while it's great we're living longer, the cost of healthcare and the decisions around healthcare become more complex. And so, Mike, you and I talked the other day about being uh, an asset manager and focusing on AUM is probably the wrong focus you should have as a financial advisor. It should be about safely helping your clients manage the risks that they're going to have in their life. Those risks are living a long life, paying for health care, who's going to provide the care, how is the care going to be delivered, what Medicare plan should I have? I'm getting inundated with flyers, and there's this thing called open enrollment. It's like flying at people that are supposed to be at a period in their life where they're enjoying things, not working or worrying. And so what I like to really and talk to the advisors about is have that conversation. This is what's on the mind of your clients, and longevity, healthcare, as I mentioned, they're big decisions for folks, and they change. They change all the time. Life happens, and if we can add certainty and get away from focusing on, hey, what's my AUM, and focus more on, hey, I'm helping clients manage the wealth that they built. And I heard this great line once before, and I'll turn it back over to you. This That was a large RIA firm based out of Miami that we work with on the insurance side. And he said, "You know what, Tim? We don't make our clients rich or wealthy. We keep them that way." And what did he mean by that? He meant, he didn't say we outperform the market or we do investments better. No, he said we help the clients manage risk and make sure, because they built their wealth or their nest egg through discipline, through hard work, through their initiative. And now it's our job as the advisor to make sure that they don't lose it and or outlive it and have a high quality of life. So I thought that was a really great way of putting it.
Yeah, I love that. I love that. Reminds me, moving towards taxation is it's not what you earn, it's what you keep, right? And one of the things that I think wasn't discussed in the Fisher investment piece is the value of tax deferred growth. They always take a look at nominal rates and then just subtract out fees. Well, it's really important that we take a look at the real rate of return. I know we've done some studies with MIGA rates and compared that with bond rates. And I mean, even today's MIGA rates and looking back, even at low interest rates in the post COVID and post financial crisis time, on a real rate of return, MIGAs outpaced some of the bond portfolios out there with the US aggregate. So I think that's something that doesn't get talked enough about, the value of tax deferred growth in the accumulation, because hopefully you're not eroding that wealth like this RIA. You're living off of the earnings and living off the income and the guaranteed income. So talk a little bit about tax deferred growth and just some of the other ancillary benefits that you talk about when you're talking about annuities.
Sure. Well, tax deferred growth is a nice thing, and there was this smart guy. I think his name was Ben Franklin, that talked about the power of tax deferral. And certainly in the accumulation phase of your life, that tax deferred can be a very powerful thing. Again, this is for looking at a portion and a piece of your portfolio to consider. And the impact of tax deferral, I think, is a powerful thing. Getting earnings on something that would be otherwise taxed grows your money faster. Now, the argument we always hear on the backside is, well, but when you take it out, it's ordinary income. And I use muni bonds, and I do all these things. Well, again, what we look to is we say compare to what? We compare financial products against the other and say this is the net result. It's not anything we get emotional about. It's math, and that's all it is. I think there's also another thing that a lot of people have used, whether they're mutual funds or other funds, and you have this thing. I think you refer to it as the loser's tax. So your fund went down, and then you get a Christmas present called a 1099, and you're like, I I lost money, and I got a 1099. So that's like adding insult to injury. And so when I we look at all of those factors, that to me is the importance of taxation. Now, there are other things that we get that are on non-qualified annuities, particularly the income ones, SPIAs and DIAs. Exclusion ratio. It's a powerful tool to be able to spread out your cost basis over your life expectancy, and you pay tax on what is considered the interest, but the other is return of your principal. And that has a powerful impact on outcomes, especially in the years where you're spending. So it affects your social security, all of these pieces and parts. Lastly, and I'll turn it back over to you. I don't want to get too long-winded here. How many people own CDs?
Oh, yeah.
How much money, Mike, is in CDs right now? Estimate.
27 trillion.
Okay. So Is tax deferral better than taxable? I think so. And there's $27 trillion out there that could be likely improved upon. Now, some of them are unqualified. I get that. But the majority of people get a 1099 interest statement. Those babies are flying in right now, aren't they, from your banks and the Fidelities and the Schwabs and the TD, all of the custodians out there. Well, that's why taxation matters, and being smart about having a distribution strategy and buckets of money that are in various taxation categories.
It amazes me that we saw a spike to safety right during COVID, like March through May, and we didn't have anything to do, so we stuck money in the bank at that point in time, right? But even after that, after we got back to our normal lives, the amount of money in CDs, money market accounts, bank accounts still is ballooning up to where it is today, like right around $27 trillion. And I encourage every financial advisor listening to this, as you're getting tax returns back, you should be asking for your client's tax returns so that you can make adjustments. Look at that interest line. Anyone who has a positive number on there could defer that tax and accumulate faster with the old Ben Franklin compounding. That's something that every client needs to make a decision on, and they need to be given a chance to do tax deferred. Even better is making sure that you're asking about their old uh, annuities, because those annuities have some significant tax built up into them, tax deferred that's already built up. One of the largest, highest chances of eroding wealth while you're alive is a long term care event between two individuals, like more than a 70% chance, I think, Tim. You can actually take that tax deferred growth to tax free if it's used for a long term care qualified. I'll guarantee you every client wants to have a tax deferred to tax free conversation. I even back that up, taxable to tax deferred to tax free.
Completely agree. And this is all about education and being aware. And all of these things are right under the nose of us as advisors, right? It's in the tax return. And you make a great point. Just pull it out and say, how much interest income did you receive, and what was your taxation on that? Show me your 1099s. Uh, that's it. That's easy. And or my consolidated statement that I get to forward. I enjoy looking at that, saying where am I allocated, and and where am I in life, and what's going on, and is there a better way to do it? And you mentioned we really hit on healthcare and retirement. That thing that you just said. How do I move an annuity that has maybe some built up tax deferred gain and move that into a qualified annuity, meaning not, I don't mean qualified as in tax qualified, but qualified that it complies with the regulation that if you do have a long term care event, all of that tax deferred gain essentially goes away if it's used for long term care payments. And a lot of people don't know that. And you can take a portion. There are some companies too, right, Mike, that do partial 1035 exchanges. I'm not sure on how that can be done. I don't want to talk to our experts, but there's so many techniques and things that we are constantly trying to scour the market for, so that we can provide better financial advice, deliver the products that are going to meet the needs of the consumer, and just stay in front of it. That's what we do.
Yeah. Yeah. Well, to put a bow on this segment, because expenses are huge, it's a legitimate conversation to have. How do I reduce my fee drag off of my portfolio? Moving from that CD that has no fee drag to a MIGA, a multi-year guaranteed annuity, no rider fees on that. to a HIPAA approved, no management fees or no rider fees, just the cost of insurance, which is minimal because it's asset based, you can eliminate a lot of retirement risk and do that without the 3.7% fee that's in the Fisher investment brochure. So I think that that's super important. There are so many different ways, so many different strategies to help improve the outcomes that need to be onto the table that just aren't discussed. And part of the purpose here is education. So Tim, we are up against time. It's amazing how we can dig into this. There are so many more questions that we're going to be going through in the next couple episodes, but I think that we've given some great conversation points for advisors to have on their meetings with clients. Anything that you want to say to wrap up?
No, just thank you. I always enjoy this, and certainly hope we're adding value. I do have one thing, a little nugget that I heard, and I'm very proud. My son's in the business, and he leads our uh, working with registered investment advisory firms on planning, usually high net worth, ultra high net worth. And he said, he talked to the advisor and he said, "Why don't you fire the most expensive asset manager?" That's Uncle Sam, because
Oh,
the he said trade tax drag for financial products that can help you put that to work to provide benefits. I was like, wow, that was pretty good. So I guess the apple didn't fall far from the tree. We talk about this all the time. So
yeah,
again, thank you. It's great being with you.
yeah, that's a great line. I'm going to be writing that one down. Thank you very much. Have a terrific day.
This episode of Accumulation to Activation was produced by Ash Brokerage. For more on the most pressing and critical issues facing financial advisors today, be sure to subscribe, leave a review, and share this episode with a colleague. For more resources, visit us at ashbrokerage.com or reach out to our team at 800-589-3000. Let's start a strategic conversation about how you can be more efficient with your retirement income and legacy planning solutions. Insurance product guarantees are subject to the claims paying ability of the issuing insurer. Annuities are insurance contracts and may be subject to fees, surrender charges, caps, spreads, participation rates, and tax implications. Withdrawals are taxable and, if taken prior to age 59 and a half, may be subject to an additional tax. Product availability and features vary by state and carrier. Social Security and tax rules are complex and subject to change. Clients should consult their tax and Social Security advisors. Any modeling or Monte Carlo analysis referenced is based on stated assumptions and are illustrative only. Results vary by client profile, market conditions, and product selection. Past or modeled results are not guarantees of future outcomes.